Welcome to Multifamily Loan Talk, the show where we teach you how to use other people's money, i.e. the lender's money, to finance your multifamily deals. On today's episode, this is our first episode where we're doing the loan review series. So on today's episode, the first loan we are reviewing is the Freddie Mac small balance loan product. Let's get into it. Okay, so we have the Freddie Mac small balance loan product in front of us here. So the first question is, why are we doing the Freddie Mac small balance loan product first? The reason we're doing the Freddie Mac small balance loan product first is because when you first get started in multifamily, most people want to start out small. Most people say, I want to start out something small and then work my way up to something big. Or I want to start out with something I can manage and then work my way up as I get more experience to more units. And so we're starting out with the small balance program because this is a loan program that targets people who want to buy multifamily properties, and they want to do it on a smaller scale. So what is this small balance loan all about? We can see right here on Freddie Mac's term sheet or product snapshot sheet, term sheet. I like to call them term sheets because it tells you the general terms of this small balance program. And so if we look at this term sheet, we can see right here that the purpose of these small balance loans from Freddie Mac is this. They want to change the way small apartment loans are done by giving you more choices, better terms, and faster, simpler loan process that fits your financing needs. So the benefit of using this small balance loan program is, your goal could be to grow your portfolio, improve your existing assets, or meet other financial goals. They have the strength and expertise to get you the financing you need, so that way you can grow to whatever you want to grow to. So this is normally a first stop when financing your multifamily deals. So most sponsors don't know that the small balance program is available to them, but it is. So let's look at this. So product snapshot, we can see that this small balance program is, if you're financing a multifamily deal between $1 million and $7.5 million, you can fit into this Freddie Mac small balance program. The terms that they have is 5 years, 7 years, and 10 years. And they have a fixed rate options, and they also have adjustable rate mortgage options, which that's what ARM stands for. So it says hybrid ARM here. They have hybrid adjustable rate mortgage options as well. So it's non-recourse. You can finance up to 80% LTV in certain markets. Interest only is available. They have 30-year amortization. They have declining prepayment penalties. The coupon pricing is held at application. So what this means is when you apply for this loan, they're going to lock in your interest rate at the time of that application. So if they tell you your interest rate is going to be 5.16 and 90 days later interest rates have increased to 6.19, at that time that you locked in, that you went through and did your application, you're going to be locked in at that 5.16 interest rate because they rate lock at application. Okay, so they have streamlined loan products and documents, certainty of executions. They have 12 lenders nationwide, and they are going to service the loan for life. Okay, so the high-level overview of this loan looks straightforward. It looks like a decent loan for anybody who is financing a property between 1 and 7.5 million. So let's scroll down and let's go into each term piece by piece, step by step. So that way you can see exactly how these rate sheets or how these term sheets are broken down. So that way you can look at it and say, okay, can I implement this into my property, into my strategy? Can I, use this loan? Can I add this to my tool belt as one of these loans that I can use to finance my multifamily property? Okay, so there are 12 Freddie Mac lenders. Now you can go and work with these lenders directly, or you can work with a capital advisor like myself that will give you other options, to other options besides Freddie and Fannie. But if you want to go and work directly with the Freddie Mac lenders, you can go to the 12 lenders that they have here, and you can click on it, and you can see who are these lenders and and how to get in contact with them. And so the difference between a capital advisor and these lenders is this lender is lending specifically for Freddie and Fannie Mac. Capital advisor is going to look at all the financing options available to you and presenting you with all the options that you have and helping you make an informed decision and the best decision for your property. So that's the main difference between a capital advisor and a lender. Lender, they'll tell you what they're looking for, they'll give you the terms, you can accept them or leave them. The capital advisor goes and get the best terms on the market, brings them back to you and says, here are the terms, which one looks the best, and let's go with these top 3 to get you the best financing on the market. All right, so that's that. So let's look at the loan amount. The loan amount, as we said, is $1 million to $7.5 million in all markets. Now they do have a stipulation here. It says that it's going to be between 6 and 7.5 million in small and very small markets. That's where the 6.7.5 million may be permitted. But if you're in a small and very small market, this is basically saying that it's going to be under 6 or 7.5 million. But they will permit it to be 6 or 7.5 million on a very select basis. Okay, so let's look at unit limitations. So is there a limitation on the amount of units that you can buy with this loan? So as we can see right here, it says loan amount is greater than 6 million and it's less than or equal to 7.5 million. And you can buy up to 100 units with this loan product. Anything above 100 units may be permitted, but you can buy up to 100 units. So if you go 101, you may be permitted to buy 101 units, but you may be forced into another product. So if you're buying anything under 100 units and under, this may be the best product for you at the time. Okay, let's move over to loan purpose. So this loan the purpose of this loan, so when you buy a deal, you can use this loan for 2 reasons. 1, to acquire a property, and 2, to refinance a property. So this is not going to be one of those loans that you use to fix up and do all that other stuff. This is going to be a loan that you use when it's stabilized. Either you're going to buy it stabilized or you're going to implement your value add strategy and then refinance into a small balance loan product or something like that. Okay, let's look at loan terms. So they have loan terms of 20-year terms. They have a 5-year, 7-year, and a 10-year term. And then they have fixed rate terms, which is 5, 7, and 10. That's pretty straightforward. Amortization up to 30 years, interest only. They have partial term interest only and full term interest only available. And obviously that's deal by deal basis. Prepayment penalties. This is a big one. So on your prepayment penalties, we'll get into that on the next page. But this is something you're going to want to focus on. So let's go to eligibility. Let's go to eligibility, and borrowers/entities. So these are the type of people who can borrow when financing a multifamily deal. So limited partnerships can borrow, limited liability companies can borrow, single assets entities can borrow, special purpose entities can borrow, tenants in common with up to 5 unrelated members can borrow, and irrevocable trust with an individual guarantor can borrow. So we can see these are all the people that can borrow. All of them. It doesn't say anything about individuals. Why doesn't it say anything about individuals? That's a good question. The reason it doesn't say anything about individuals is because it goes back to our recourse and non-recourse. We can see down here that it says this loan is non-recourse. When it's a non-recourse loan, 9 times out of 10, there's still a 1% chance, But 9 times out of 10, you're going to put that property into a SPE, which is known as a special purpose entity, that will either be an LLC, whatever entity works best. I'm not an attorney. Consult with your attorney about that. Don't take this as legal or financial advice. But most of the time, a property is going to be put into a special purpose entity, and that entity is what you're going to hold the property in. So that way, in the event that there is a bankruptcy or foreclosure on the property, they're going to foreclose on that property, on that entity, and everything in that entity is what the bank will foreclose on. Meaning that it's non-recourse to the owners or you personally for the property, but it's recourse with the entity itself within the property. All right, that's too much legal mumbo jumbo. All right, so we have recourse and non-recourse. Non-recourse with standard carve-outs, that's pretty standard across the board. So here they will not permit subordinate debt. What that means is they will not have anybody take a second lien position behind their lien. Straightforward. Let's move over to net worth and liquidity. So in order to use this financing, there's 2 requirements. You must have a minimum net worth equal to the loan amount. That's 1. And then the liquidity is that you must have liquidity equal to 9 months of principal and interest payments. So how do you calculate this? So if you're financing a $1 million loan, you or your team within your LLC needs to have a $1 million net worth. And you need to have 9 months of principal and interest. That means whatever your payments are for that property, whatever your payments are for that loan, you need to have 9 months of those payments tucked away, liquid, ready to go. All right, let's move up. So you're probably wondering, what kind of properties can I finance with this Freddie Mac small balance program? So they tell you right here, straightforward way. You can finance multifamily housing with 5 units or more. 5 units or more, multifamily, that's commercial. Okay, this includes properties with tax abatements. You can do it. This includes age restricted properties with no resident services. This includes properties with certain commercial non-residential uses, such as mixed use, where you put multifamily at the top and commercial space at the bottom. This includes properties with tenant-based housing vouchers. This includes low-income housing tax credits and land use restriction agreements, also known as LURA, that are either in the final 24 months of the initial compliance period or the extended use period. Investors must have exited. So this includes properties that have low-income housing units allocated, that have low-income housing units within that property. And this includes properties with certain regulatory agreements that impose income or rent restrictions, provided that all funds have been dispersed. So they tell you all 5 of the details, all the types of properties that you can buy with this loan. Now, the next question is, what can't I buy with this Freddie Mac small balance loan? So you cannot buy senior housing with senior care services. You cannot buy student housing greater than 50% concentration. You cannot buy military housing. You cannot buy properties with project-based housing contracts, including project-based Section 8 housing contracts. You cannot buy lower properties in compliance. You cannot buy lower properties that's in compliance within years 1 through 12. You only can buy those properties if they're in the last 24 months of that LURA agreement. You cannot buy historic tax credit properties with a master lease structure. And you cannot buy tax exempt bonds, interest reduction payments. All right, so that's that. Occupancy. In order to use this type of financing, this property must be occupied at least, must have a physical occupancy of at least 90%. That means that this property must be stabilized for 90 days before you can use this type of financing. Okay, let's move over to our replacement reserves and our escrows. So your underwritten replacement reserves will be determined by your risk report, which says right here, your physical risk report. This will either be, you'll either get a grade of low, moderate, or high. If you have a low grade, then your replacement reserves will be 200. If you have a moderate rate, then your replacement reserves will be 250. And if you have a high rate, then your replacement reserves will be $300. All right, escrows. Real estate tax escrows deferred for deals with an LTV ratio of 65% or less. Interest, that's pretty straightforward. Let's move down to our fixed rate and our hybrid and our interest only terms and all that, and then we'll be done with this sheet. Okay, so fixed rate and LTV and DSCR and all those requirements. So as we can see right here, if they have broken this down into market tiers. So if you're in the top small balance loan markets, your minimum DSCR will be 1.20% and your maximum LTV will be 80%. You can see right here. If you're in a standard small balance loan market, that's what SBL stands for, then your minimum DSCR will be 1.25 and your maximum LTV will be 80%. Now, if you're in a small SBL market, in the small markets, all this is determined by Freddie and Fannie. It's pretty much standardized. But if you're in a small market, then your minimum debt service coverage ratio is 1.30 and your maximum LTV is 75%. And if you're in a very small SBL market, then your minimum DSCR is a 1.40 and your maximum LTV is 75%. Now, all of these can be adjusted up and down based on Freddie Mac and at Freddie Mac's sole discretion. All right, now let's look at our interest only. So we did say that it has full term interest only and partial interest only. So if you're in the top and standard market, if you're on a 1-year loan, if you're on a 5-year loan, you can have a 1-year interest only period. If you're on a 2-year loan, you'll have if you're on a 7-year loan, you'll have a 2-year interest only period. And if you're on a 3-year loan, you'll have a 10-year interest only period. Now, what about if you're in a small and very small market? So if you're on a 5-year loan and you're in a small market, you'll have a 0-year interest only period. If you're in a small market and you want a 7-year loan, you'll have a 1-year interest only period. And if you're in a small market and you want a 10-year loan, you'll have a 2-year interest only period. Now, what if you want full term interest only? Then your maximum LTV can be 65%, and they're going to require that you have a 1.25. You're gonna adjust your baseline, meaning that your debt service coverage ratio is going to go up by 0.15%. So if you are in the top market, then you're going to have a minimum DSCR of 1.35, and you're going to have a maximum LTV of 65% if you want full interest only on your loan. So that has been a review of the Freddie Mac small balance loan product. Most people will use this Freddie Mac small balance loan product when they are financing a property between 1 and 7.5 million, that the property is already stabilized, meaning that it has 90% occupancy within the last 90 days, and the property is under 100 units. You can use this loan up to 80% LTV. It's non-recourse. And if you're in a market where if you're a new sponsor and you're just trying to fill out, how to get started in the multifamily and all of that, this loan may be a great product for you. Now, if you're looking to do value add and increase the rents and then increase the occupancy and all of that stuff, then this product won't work because they need this product to be stabilized in order to give you this loan. But if you're looking for a loan where you can do your value add strategy and all of that, then a bridge loan may be the better option for you.
But we'll learn about bridge loans when we look at bridge loan products. So that is it for today. Make sure you leave a like, you share, and you subscribe, and I will see you here tomorrow.